Hi everyone, welcome to video classes. Myself is Venkata, Assistant Professor, Department of Management Studies in Madanapalle Institute of Technology and Science, Madanapalle. Now I am going to explain the capital budgeting techniques. So before going to explain the capital budgeting techniques, what do you mean by capital budgeting? Where we can apply? So capital budgeting is one of the components or important activity in the financial management. In the financial management, capital budgeting plays a vital role to take the investment decisions by the management. So, capital budgeting is also called as a investment decision. So, the capital budgeting can be helpful to take the investment decisions by the management. So, before going to make a investments in a particular proposal projects, the company has to know, is it financially feasible project or not, is it profitable project or not. So because of the company is going to make a huge amount of funds in a proposal project. So apart from that one, the company wants to know, the company wishes to know, is it profitable project or not. If it is profitable projects, then the company will take a decisions to make an investment in that project. So apart from that one, as a financial manager, we have to know the project is profitable or not. Then capital budgeting is helpful to the financial manager to provide the necessary data or information to the top level management to take the managerial decisions. So capital budgeting plays a vital role in the financial management. So what do you mean by capital budgeting? So the capital budgeting plays a vital role. Already I told you. Capital budgeting is the combination of towards capital and budgeting. Capital is required. Capital is nothing but the how much amount of funds are required to start a business, the how much amount of funds are need to do the projects. But budgeting is nothing but allocation of the funds to various profitable projects. So in this lecture, I want to explain the features of capital budgeting, application of capital budgeting, evaluation of capital budgeting. So features of capital budgeting. So here, capital budgeting is already I told it is comes under the investment decision. The exchange of current funds for future benefits. It means now the company is going to make a investments in a specific project. That project will provide a beautiful and profitable benefits in the future. At the same time, the funds are invested in long-term assets. What I said that one in the beginning, capital budgeting can be helpful to take the investment decision. So, but here investment decisions in many aspects we can take a investment decisions on financial assets and physical assets. Financial assets is nothing but if they make investments on securities markets and shares, debentures, bonds, and mutual funds. But this capital budgeting can be helpful to take the physical investment decisions so that the funds are invested in long-term assets only, right? And the future benefits will occur to the form over a series of years. Whatever funds we invested, the results will be gets throughout the project period. So that is the things, the features of the investment decisions. The next one, where we can apply the investment decisions or where we can apply the techniques of capital budgeting. The capital budgeting techniques we can apply in different areas. One is the new project where the company is going to make an investment on new projects and where the company is going to take up the new ventures. Then is it project or ventures, is it profitable or not? If you want to know is it profitable or not, we can apply the capital budgeting techniques. And capital expenditure. Capital expenditure is nothing but the expenditure is make a for purchase of technology, purchase of plant and machinery, where the company is going to make an investment in the capital areas, then is it profitable plant and machinery? Is it profitable technology? Uh, at the time, if you want to know those things, we can apply the capital budgeting technique. And the replacement decisions. Already we have a technology, we have a plant and machinery. Now we are going to replace of existing technology, existing plant and machinery. Then if you purchase of new plant and machinery, new technology, then we can apply the capital budgeting technique. And infrastructure projects, it is also one more way where the capital budgeting techniques is applied. Infrastructure projects like road construction of roads, construction of buildings, construction of flyovers, we can apply capital budgeting techniques. Now, how we are going to evaluation of the projects, or how we are going to evaluation of the investment? Here, different types of techniques are there, different types of methods are there to evaluate the capital budgeting. So, what I said that one in the beginning, the company before going to make a investment in a specific project, the company has to know, is it profitable project or not. After that, they will take a decision to make an investment or not. So apart from that one, first of all, before going to make an investment, we have to know evaluation of that project. Financially, is it possible? Is it preferable or not? So apart from that one, here some project evaluation techniques are available. So that project evaluation techniques is called as a capital budgeting methods. Here we have two methods are there. That is a traditional method, and one more is the modern method. What's the traditional method? Traditional method are classified into two types: payback period and accounting rate of return. Payback period and accounting rate of return both are comes under the traditional method. So the payback period where we can apply, accounting rate of return where we can apply. First, we have to know the payback period. So the payback period and accounting rate of return both are the techniques of uh, traditional method. So we can see first to payback period. What do you mean by payback period? Payback period is a one of the project evaluation technique. It comes under the traditional method. It refers to the how much amount of time is required to recovery of our initial investment, or number of years are required to recovery of initial investment. It means the how much amount of time is need to get back of our initial investment which are going to make an investment in a specific project. So this can be helpful to the investors, but how much time is take to recovery of our initial investment. So here the how we are going to measure the payback period. Here two kinds of ways, in the two situations we can measure the payback period. The cash flows of the project, the estimated cash flows of the project, even the estimated cash flows of the project are uneven. If the cash flows are even, the payback period is calculated. Payback period is unequal to initial investment divided by average cash inflows. That kind of formula can be useful to measure the payback period if the cash flows are even. And coming to the next one, if cash inflows are uneven, in this means the first year, if the project life period is 5 years, the first year we will get 50,000, second year we will get 60,000, seventh year, third year we will get 70,000, and fourth year we will get one more amount. So these are the uneven cash inflows. In that uneven cash inflows, payback period is going to measure base year plus required amounts divided by next year cash inflows. This formula can be useful to the payback period. So the payback period is refers to the number of years are required to recovery of our initial investment, which is going to make a investment on a specific project. But how we are going to take the decision under the payback period, that's an important. So here project accepted if actual payback period is lower than the standard payback period. For example, if actual payback period of the project is 3.5 years, but the standard payback period is the 3.9 years, it means our actual payback period of the project is lower than the standard payback period of the project, then the project will be accepted. If the project actual payback period is higher than the standard payback period, the project will be rejected. In sometimes two or more projects is compute with each other. At the time, which projects are having the lowest payback period, that project will be accepted, remains will be rejected. So these are the payback period decision criteria. Under the payback period techniques, where we can apply the payback period techniques, we can take the decision like this manner. So that is the payback period. And coming to the next one, accounting rate of return. Accounting rate of return is also one of the project evaluation technique. It comes under the traditional method. It refers to the relationship between the average annual earnings after tax and average investment. So it can be measure the relationship. It can be measure the relationship average annual cash inflows after tax and average investment. So here also the following formula. It means the formula can be useful to take the investment decision under the accounting rate of return. So average annual earnings after tax divided by average investment into 100. Here how we are going to take the investment decisions. Here if the project accounting rate of return is greater than the standard accounting rate of return, the project will be accepted. The project will be rejected if actual accounting rate of return is lower than the standard accounting rate of return. And if two or more projects compete with each other, which projects are having the highest accounting rate of return, that project will be accepted, remains will be rejected. Finally, accounting rate of return is indicating that one. Yeah, accounting rate of returns are which projects is having the highest than standards, so then will be accepted, remains will be rejected. That is the accounting rate of return. But of course, traditional methods are um, uh, having the some limitations. In that, main limitation is that in the traditional method, they ignored time value of money. They ignore time value of money. Generally, if you want to take a investment decision, definitely time value of money plays a vital role. But in the traditional method, they ignore time value of money. So that's the main drawback and the main limitations of traditional method. So and the modern methods are came into the picture. So modern methods is nothing but they accepted time value of money. So it is the traditional method is a mainly drawback is the ignore of time value of money. The modern methods they accepted they consider time value of money. So modern methods is evaluated that a project under the help of time value of money. So in that we have three techniques are there under modern techniques. It is a modern techniques also is called as a discounting techniques. Discounting techniques because of their applying time value of money. In the time value of money, we have two components are there. One is the compounding factors. Another one is the discounting factors. Now we are going to discuss about the discounting factors. We are applying discounting factors to measure the and to evaluate the modern techniques. Under modern techniques, we have under modern methods we have three techniques are there. One is the net present value, second one is the profitability index, and third one is the internal rate of return. So now we are going to discuss about net present value. Net present value is a one of the project evaluation technique. It comes under the modern method. It refers to the difference. It is widely accepted technique also. It is widely accepted techniques for evaluation of the project, but it refers to the difference between present value of cash inflows and present value of cash outflows. It means here the company has to conversion of future cash inflows into present values. Because of, for example, if the company invested rupees 2 lakhs in a specific project, the project life period is a 5 years. If the first year we will get 60,000, 70,000, 80,000, 90,000, 1 lakh, simultaneously we will get that future value has to be converted into present values. So that's why present value of cash inflows and present value of cash outflow. So if NPV is a positive, the project will be accepted. The project will be rejected if NPV is a negative. So if two or more projects compete with each other, which one having the highest NPV, that will be accepted, remains will be rejected. So that is the net present value. And coming to the next one more technique, that is a profitability index. Profitability index is also one of the project evaluation technique. It comes under the modern methods. It refers to the relationship between present value of cash inflows and present value of cash outflow. So here the project is accepted. The project is accepted if profitability index is 1 or greater than 1. If the project is rejected if profitability index is lower than 1. So if two or more projects compete with each other, which projects are having the highest profitability index, that will be accepted, remains will be rejected. So that is the profitability index. And coming to the next one and last one, that is the internal rate of return. So internal rate of return is also one of the project evaluation technique. It comes under the discounting method. It refers to which discounting rate equates the present value of cash inflows and present value of cash outflow. So that is the internal rate of return. That internal rate of return has to be compared with the cost of capital. The cost of capital is a plays a vital role in the modern techniques. Whatever internal rate of return we found there, that has to be compared with the cost of capital. If internal rate of return is greater than the cost of capital, the project will be accepted. If internal rate of return is lower than the cost of capital, the project will be rejected. So internal rate of return can be helpful to take the investment decision when compared with the cost of capital. So the cost of capital plays a vital role in the modern techniques and discounting techniques. So that is the internal rate of return. Now, till now, we have known what is the theoretically, what is capital budgeting, where we can apply, what are the methods are available to evaluate the projects. So under that, we known traditional method, we known modern methods, and traditional method, payback period, accounting rate of return. In the modern method, we known or net present value, profitability index, as well as internal rate of return. So now we are going to apply them. So we can take the small examples. Here, see, one company is there, Sunshine Company Limited, wish to invest funds on a project. But here, two projects are available. The cost of the two projects, rupees 2 lakhs, estimated life of the both projects 5 years. And you suggest that which project is better to us. Other details is as given below. Here the company wish to make a investment in a project, but in the two projects are available in the market, project A and project B, and both projects cost will be rupees 2 lakhs, but estimated life of the projects 5 years. 5 years. The estimated cash flows after tax is as given below. In the first year, project A 45,000, 55,000, 65,000, 55,000, and fifth year 45,000. It means if the company invested rupees 2 lakhs on project A, that from the project A we will get 45,000 rupees in the first year, we will get 55,000 rupees in the second year, we will get 65,000 rupees in the third year, we will get 55,000 in the fourth year, and we will get 45,000 rupees in the fifth year. So these are the cash inflows of the project A. So these are the uneven cash inflows. The same amount invested in the project B, 40,000. First year we will get 40,000. Second year we will get 55,000. And third year we will get 60,000. Fourth year we will get 55,000. Fifth year we will get 40,000. So now we are going to take the investment decisions. But the company wish to make investment only one project, not to two projects. So as a financial manager, you have to suggest that company which project is profitable and why. Based on the here, we can see which project to having the highest to lowest payback period. Lowest to payback period. Project A and project B. Project A payback period and project B payback period. We have to compute. After that, which projects are having the lowest payback period, that will be accepted. Remains will be rejected. So that is the thing. Whatever decisions we have given in the beginning of the class, Payback period. What do you mean by payback period? The number of years are required to recovery of initial investments. For example, project A, payback period 3.5 years. Project B, payback period is 4 years. Definitely, obviously, we can accept the project A because of if you make an investment in the project A within 3.5 years, we can get back of our entire capital, which is going to be invested on project A. So that is the how we are going to take a decisions. And coming to the next one, accounting rate of return. Under the accounting rate of return, how we are going to take the decisions. See here, Blue Star Company Limited wish to invest of their funds on a project, but here two mutual exclusive projects are available. Cost of both projects 2 lakhs and 2,50,000 respectively. Estimated life of the projects, both the projects 5 years. And you suggest which project is better to us. Other details is as given below. See, for example, according to this example, Blue Star Company Limited is there. The company wish to make an investment in a specific project. That here two mutual exclusive projects are available in the market. If you make an investment on a project A, the cost will be rupees 2 lakhs. If you make an investment on project B, the cost will be rupees 2 lakh 50,000. The life period of both the projects 5 years. So if you make a investment on project A, you will get rupees 45,000 in the first year. You will get 55,000 rupees in the second year, and you will get 65,000 rupees in the third year, and you will get 55,000 rupees in the fourth year, and you will get 45,000 rupees in the fifth year. And same if you invest on the same amount, 2,50,000 in the project B. First year you will get 50,000, second year you will get 55,000, third year you will get 60,000, and fourth year you will get 65, and the last 50,000 rupees you will get. These are the things what they are asking. Under the accounting rate of return, you suggest the which project is profitable. They're asking us. So we need to find out the accounting rate of return for both the project. Then we will take a decision whether it is acceptable or not. And coming to C, here already we told how we are going to measure the accounting rate of return. Accounting rate of return measuring with two components or two input components is required. One is the average annual cash inflows of the project and average investment. Average annual cash inflows, so according to our case study, 45,000 plus 55,000 plus 65,000, 55,000 plus 55,000 divided by 5. Then you will get average annual cash inflows after tax rupees 48,000. And average investment is unequal to average investment 2 lakh. If any scrap value is there, na, that scrap value you deducted plus additional net working capital minus scrap value divided by 2. That's the equation. According to that equations, here additional net working capital is not there and scrap value is not there. So only initial investment is there. There is a 2 lakhs. 2 lakhs divided by 2, then you will get rupees 1 lakh. So accounting rate of return unequal to average annual cash inflows divided by average investment. According to our case study, 48,000 rupees 48,000 is the average cash inflows after tax, and average investment rupees 1 lakh. That has to be multiplied with 100, then you will get 48%. That is a project A. It means if you make a investment rupees 2 lakhs on a project A, you will get 48% of return entire the project life period. And coming to the project B. In the project B, average cash inflows 50,000 plus 55,000 plus 60,000 plus 65,000 plus 50,000 divided by 5. Then 56,000 rupees is the average cash inflows. Average investment 2,50,000 divided by 2, then 1,25,000. So then 56,000 divided by 1,25,000 into 100, then you will get 44.8%. So if you invest of your funds on project B, you will get 44.8%. If the same, if you invest the amount in the project A, you will get 48%. So this type of information you peoples are providing to the top level management, they will take a decision. Simply we can understood, if you invest a project, if you invest the funds in the project A, you will get 48%. If the same amount invested uh, for project B, you will get 44.8%. The simply we can say the project is a profitable project. The project A is the profitable project. So you better to make an investment on project A, because of project A accounting rate of return is greater than project accounting rate of return. So that is the accounting rate of return. So based on the rate of return, we can take the decision based on the time period, collection period, how much time it recovery of our initial investment, then we can apply the payback period. So, and coming to the next one, discounting techniques. Already we told what are the some differences is there. The major difference of traditional method and modern method. In the traditional method, they ignore time value of money, and the modern methods they consider time value of money. So that's the difference. So while taking the investment decision, definitely time value of money plays a vital role. So what do you mean by time value of money? The value of money is different in different time periods. That time value of money is depends upon the two legs. That is, one is the compounding factors, and the one is the discounting factors. So now we can apply here discounting factors. So that is called it is a discounting techniques. Why it is called as a discounting techniques? Because of we are applying discounting factors while evaluation of the project. So that's why it is called as a discounting technique. Here one problem, we take one case study we took, that is a Six Sigma Company Limited wished to invest their funds in a technology. That technology cost rupees 5 lakhs. Life period of the technology 5 years. The expected future cash inflows after the tax is as given below. So cost of capital 10%. Here see the company wish to buy a technology. Why we are going to buy the technology? For reduction of the cost and improvement of the production. So that based on that conditions, the company is wish to buy a technology, new technology. Already existing technology is there. The company wish to replace the new technology, but the new technology cost will be rupees 5 lakhs. The life period of the technology 5 years, and the cost of capital will be 10%. So if the same 5 lakhs rupees invested in the technology in the first year, that from the technology we will get 80,000 rupees in the first year. Second year we will get 1 rupees 1,50,000, and third year we will get rupees 1,90,000, and fourth year we will get rupees 1,50,000, and fifth year, the last year, we will get rupees 1,20,000. These are the expected and estimated cash inflows of the technology, and we need to find out the technology is a profitable or not. So here we can apply the different techniques under the discounting model, under the modern methods. So first one is a net present value. Now here two inputs are essential. Three inputs are: one is the initial investment that is already available in the problem, and estimated cash inflows of the project that also is available in the problem, and cost of capital that also is available in the case study. So here three components are essential to measure the net present value or profitability index or internal rate of return. These are the three techniques which are comes under the modern methods. Now we are going to discuss about the net present value. Under net present value, how we are going to take the decision. Right. First one, computation of net present value. See, first we make a four columns table. First one column years, second column estimated cash flows of the project after tax, and second one cost of capital, discounting factors, and present value of cash inflows. See, first year, second year, third year, fourth year, fifth year, all 5 years uh, we recorded here only, and cash flows after tax also is given there, and present discounting factors 10% discounting factors. It means 0.909. It means what one rupee you will get 1 rupee after completion of 1 year at 10% rate of interest. What's the present value of 1 rupee which we will get after 1 year? That is the 0.909. And second year uh, 0.826. It means what? if you get 1 rupee after completion of 2 years, what's the present value of cash inflows? That is a 0.826 and 0.751. After completion of 3 years, what's the after completion of 3 years, if you get 1 rupee, what's the present value of 1 rupee? And if you want to get 1 rupee after completion of 4 years, what's the present value of 1 rupee? If you want to get 1 rupee after completion of 5 years, what's the present value of 1 rupee? These are at 10% rate of interest. At 10% rate of interest, that's a discounting factors. These factors are available in the table, or some formula is there. According to table or formula, we can find out the 0.90, 0.826, 0.2751, 0.683, 0.61. These are the 1 rupee value will get in the respect to years in the future. What is the present value of 1 rupee? That is a thing. And that's the thing. That has to be multiplied with 1,20,000. It means 1,20,000 rupees you will get after completion of 1 year. What's the present value of 1,20,000? That's an important. So that's why 0.909 has to be multiplied with the 1,20,000. Then you will get 1,09,080. That is the present value of 1,20,000. It means 1,20,000 rupees you will get after completion of 1 year. Now the present value of 1,20,000 is 1,09,080. At the same time, 1,80,000 rupees you will get after completion of 1 year. What's the present value of 1,20,000? That has to be multiplied with 0.826. Then you will get 1,48,680. And you will get 1,90,000 rupees after completion of 3 years. What's the present value of 1,90,000? 1,42,690. And you will get 1,70,000 rupees after completion of fourth year. What's the present value of 1,16,001? At the same time, fifth year also will consider. And some of what is given a definition of net present value. Net present value is refers to the difference between present value of cash inflows and present value of cash outflow. The sum of present value of cash inflow is nothing but 6,15,920. 6,15,920 is the present value of future cash inflows. Present value of future cash inflows. And present value of cash outflow is nothing but initial investment. That is 5 lakh. So net present value 1,15,920. So here already I said in the beginning of the class the decision criteria. How you are going to take the decision under the net present value technique. If the project will be accepted, if net present value is positive, the project will be rejected if net present value is negative. According to our case study, net present value will be positive, so the project will be accepted. If the company make a investment on the technology, from the technology, the company will get some benefits, the company will get some profits. So it is a acceptable project under the net present value technique. Now under the coming to the next one, profitability index. If the profitability index is also one of the project evaluation technique, it comes under the modern method. But here it measures the relationship between the present value of future cash inflows divided by present value of cash outflow. So the present value of future cash inflows divided by present value of cash outflow. According to our case study, already here is given 6,15,920 divided by 5 lakhs, then 1 lakh, that definitely 1 point something will come. That is it is a greater than 1. The profitability index is always the value will be greater than 1. The project should be accepted. And coming to the next and the last most important is a computation of internal rate of return. Is a NPV and internal rate of return both are plays a vital role in the modern techniques. And coming to the next one, computation of internal rate of return. So here, before going to know the internal rate of return, first of all, we have to know the fake back period. Fake back period is nothing but initial investment divided by average cash inflows. According to our case study, initial investment 5 lakhs, average cash inflows 1,64,000. then you will get 0.3.048. 3.048 is the value. This value has to be checked into the, here discounting factor tables are there. Two tables is there, present value tables is there, present value annuity factors tables is there. Present value factors table is there, and present value annuity factors tables is there. So we need this value has to check out to in the present value annuity factors table. Then we can confine to the internal rate of return lies between 18 to 20%. 18 to 20%. So here we have to know the present value of present value at 18% and we have to know the at 20%. According to, see here, if you observe that one 18% to 18% to and 20% discounting factors here, if the company invested 5 lakhs rupees in the first year we will get 1 lakh 20, second year we will get 1 lakh 80, and third year we will get 1 lakh 90 and 170 and 1 lakh 60,000 in the fifth year. And at 18% discounting factors, at 18% rate of interest, if you want to get 1 rupee in the future, what's the present value? 0.847. If you want to get 1 rupee in the second year at 18% rate of interest, 0.715. At the same way, if you calculated that one, 0.847, 0.718, 0.609, 0.516. According to that, these discounting factors, if you multiplied with the future cash inflows of the present cash, future cash inflows of the project, in the first year 1,20,000, then 1,20,000 multiplied with 0.847 in the present value 1,01,640, 1,80,000 multiplied with 0.718, 1,29,240 will get, that is the present value. And third year we will get 1,90,000, and what's the present value? 1,15,710. So like that we have to compute all those things, and to sum up all those things, so 5,44,230, and at a 20% rate of factor. And here 40, the same manner, the same methodology, if you applicable that one, 4,84,570. Here one value it must be greater than the discount initial investment. One value it must be lower than the initial investment. Based on that, we can choose the discounting factors. While after payback period 3.0482, the value it must be available in the present value annuity factors table. One value it must be greater than the 0.348, and one value it must be lower than the 3.0482. If you take the percentages, then you will appear here also present value of cash inflows at 18% discounting factor 5,04,230. At the same at 20% to discounting factor, the present value 4,84,570. 4,84,570 is lower than the initial investment, and 5,04,230 is the higher than the initial investment. Then we can apply the formula to measure the internal rate of return. See, internal rate of return here, the designing of the formulas based on the others will take a, but here I will take a formula, design the formula for easiest of the student. LDR plus LDRV minus II divided by LDRV minus HDRV into HDR minus LDR. It means LDR means lowest discounting rate. Here two discounting rate we took, that is the 18% and 20%. Which one is having the lower? 18 is the lower, so 18 plus. And LDRV means lowest discounting rate value. Here lowest discounting rate was 18. Their value 5,04,230. So 5,04,230 minus initial investment 5 lakhs divided by lowest discounting rate value 5,04,230 minus 4 lakh HDRV. HDRV means highest discounting rate value. Highest discounting rate here 20% to their value will be 4,84,570. That has to be recorded here. And HDR minus LDR. HDR means what? Highest discounting rate. LDR means what? Lowest discounting rate. Here highest discounting rate 20%, lowest discounting rate is 18%. So the answer will be 12.09%. So 12.09% to here I will consider as a thing, and 18 point to something 0 point will come. That is the value of the thing. Here the value, it must be greater than the, if the project is accepted, if internal rate of return is greater than the cost of capital. If internal rate of return here cost of capital 10%. Cost of capital means if you borrow the 10 lakhs rupees at 10% rate of interest, the same amount invested on this project, that project will offer um, 18.43%. So if you invested, the cost of capital will be 10%. The internal rate of return is 18.43%. So the project will be accepted. So in the three areas, in the three techniques, the project is a acceptable project. So the company will take a decisions to make an investment on this technology. So the technology will provide some returns to the company. From this technology, company will get a benefit. That is finally I'm saying. So these are the whatever things we took that one. These are tables, present value, annuity factors tables. Based on the present value annuity factors, see in the beginning what I said, that one 5 is there now. The values will be consider here only 18% is 3.2127, 18% to 2.991 is the 20% to 2.991 is the lower than the 3.0482, and 3.2127 is a greater than the 3.0.482. So that is a annuity factors tables we can apply. So that is the things on summary of the things. Once again, the project decisions, we are going to take the project decisions. The before going to make an investment by the company in a specific projects, in a specific investment, before that management has to know, is it a profitable project or not, because of the company has to make a huge amount of funds. Before going to make a huge amount of funds, first of all we have to know, is it profitable project or not. So apart from that one, we can apply the capital budgeting techniques. That capital budgeting techniques can be helpful to the management to indicates is it profitable project or not. And four five techniques are there. Two techniques from the traditional method, three techniques from the modern methods. The five techniques. This is the one side coin of the capital budgeting. Another side coin of the capital budgeting we'll see in the next class. So thank you.